Happy Monday, everybody. Today is November 10th, 2025, and this is your Monday market update. Now, last week saw the market's record-setting rally face its stiffest challenge yet, as valuation concerns, especially among AI stocks, sparked a widespread correction. Strong private sector data was quickly overshadowed by a surge in layoffs and comments from Wall Street executives, which collectively drove the major indices to their largest weekly decline in months. The sell-off broke key technical support levels and dramatically increased market volatility. Let's go through day by day. Markets opened mixed but managed to grind higher, fueled by continued optimism over AI deal making following the strong finish to October. The core driver was an announced $38 billion deal struck between Amazon and OpenAI, with Amazon providing both NVIDIA chip clusters and cloud services. Now, remember what I said last week about the Oprah type deal announcements from OpenAI and NVIDIA. Seems like you get a deal, you get a deal, you get a deal, and then the stocks go up. So the advance began to stall mid-afternoon as the Wall Street Journal reported that Trump officials torpedoed NVIDIA's push to export AI chips to China, which triggered some light selling pressure. On the eco data end, the ISM manufacturing index fell to 48.7. That's below the 49.5 estimate, signaling a mild deterioration in factory activity, although details were mixed enough to be considered a Goldilocks report. Remember, with the shutdown, eco data is private and it's sparse. The Dow was down 0.5%, S&P up 0.25%, the Nasdaq was up 0.5%. Risk-off sentiment returned aggressively as high-valuation tech stocks and small caps underperformed. On Tuesday, the day's selling was primarily driven by market sentiment and profit-taking after the recent unsustainable separation of tech from the rest of the market. The S&P 500 dropped over 1% in early trading to a 2.5-week low. The tech sector did suffer after major Wall Street bank executives, including Goldman's David Solomon and Morgan Stanley's Ted Pick, they publicly cited lofty stock market valuations and the risk of a market correction. Now, take note, they both indicated that one was coming in the next 12 to 24 months. And this, we know, we've been through this on these videos. Markets have regular corrections and regular pullbacks and regular recessions. This is a part of the long-term investment planning we do. AI darling Palantir fell 8% despite reporting robust earnings and offering strong forward guidance, which was cited as profit-taking against elevated expectations. The dollar index broke out above the psychological 100 mark for the first time since July. Now, that does present a headwind on dollar-denominated assets. The Dow was down 0.5%, S&P down 1.25%, the Nasdaq was down over 2%. Stocks staged a rebound midweek, recovering a significant portion of Tuesday's losses, largely driven by surprisingly strong U.S. eco data and optimistic comments from China. Bullish momentum stalled near key technical resistance about 68.30 on the S&P. The rally was supported by very optimistic comments about the Chinese economy out of the Chinese themselves. The more important ISM services index rose to 52.4 versus a 51.0 expected, still solidly in expansion territory over 50. And the ADP employment report bounced back to 42,000 jobs versus a 25,000 jobs expected. This reinforced the narrative of a stable economic growth. The only negative detail in the report was that the price index component rose to a 3-year high, suggesting underlying services inflations remain firm and pushing back on the case for a December rate cut. The Dow was up 0.5%, S&P up 1/3%, the Nasdaq was up 2/3%. Risk off returned with force. You get this back and forth. Risk off returned with force on Thursday as negative private sector labor data dominated sentiment and stocks closed below key moving averages. The downbeat news continued with House Speaker Johnson expressing doubt about the shutdown ending, and the FAA announced a 10% cutback in domestic flights due to unpaid air traffic controllers and safety concerns. The index later rebounded after President Trump confirmed no new tariffs would be announced while the Supreme Court case is pending. The huge negative catalyst was the Challenger jobs report, another private report showing 153,000 jobs cut in October. That's 175% month-over-month increase and the highest October reading since 2003. This spike stoked fresh concerns about the sharp drop-off in the labor market. Now, while that should have stoked thoughts about more rate cuts, the narrative was growth scare. At least on Thursday it was. Policymakers, including the Fed heads Goolsbee and Hammack, they expressed reluctance to cut rates in December, citing still elevated inflation pressures. We just talked about those, and that was the other side. The Dow was down almost 1%, S&P down a bit over 1%, and the Nasdaq was down more than 2%. To close out the week, the market showed initial weakness but recovered from the session lows as key technical support levels were tested and held. The day was volatile, but the indices closed off session lows. The S&P briefly dropped below its 500-day moving average for the first time since May, testing a critical line in the sand technical level before it recovered to close above it. Geopolitical risks surfaced as a Ukrainian drone strike on Russia's oil refinery refinery resulted in it being shut down. The VIX, the volatility index, surged 25% on the week, closed above 17, highlighting the elevated risk. The S&P 500 closed back above the 50-day moving average, did provide a positive technical signal despite the overall market pain. For the Dow, the Dow barely closed in the green, up less than 0.25%. S&P also about the same, less than 0.25%, higher but green, and the Nasdaq was down almost 0.25%. At the lowest point in the day on Friday, the Dow was down almost 1%, S&P down 1.33%, the Nasdaq was down over 2%. The recovery, which came pretty much with news about things that were going on in Washington, we'll get to that in just a second. The recovery was welcome, but the week still closed in the red. The Dow and S&P were each down over 1%, and the Nasdaq was down about 3%, the worst 5-day period since April. Overall, in corporate earnings, the week saw over 136 S&P 500 companies reporting, with no Magnificent Seven reports, allowing the market to focus on broader fundamentals outside of the tech giants. Companies that missed earnings saw their stocks decline on average about 5%, while those that beat rose only 0.1% on average. At some of the extremes, the surge in NVIDIA, which topped $5 trillion in market cap on October 29th, moved from $4 trillion to $5 trillion in just 78 trading days, highlighting the extreme concentration and valuation risk that plagued the market this week. The monthly winning streaks for the major indices did end. At the end of October, did not end. The S&P 500 has a 6-month streak. That's the longest since 2021. The Nasdaq is going on a 7-month streak, the best since 2017. And Berkshire Hathaway reported a cash pile of $381 billion. It does continue to underscore the cautious stance of some major investors with high equity valuations. Bond yields fell, and probability of a December Fed rate cut moved back up to around 72%, despite recent hawkish commentary. Now let's look at the week ahead. While the market enters this week wounded, with downside risk elevated after the Nasdaq broke some key technical support levels, the focus is squarely on Fed commentary, signs of continued economic stability amidst a backdrop of political gridlock and volatility. Let's talk about the government shutdown for a second. It remains the longest on record and is now causing major disruptions to Thanksgiving holiday travels, creating significant uncertainty and negative sentiment, of course. News as of this morning is that there is major progress, and that is well received by markets. And here we go. As I've said many times, and today's a great example with just this news, markets that want to go up, and most of the time they do, they see a reason to buy in anything. Government shutdown was not a major reason to sell, according to most for last week. There's a lot of other reasons. But when it looked like it will reopen, that's a reason to buy. Now, that is what we have today. Again, this is the question. Crucial reports like CPI, retail sales, PPI, they have been postponed, leaving investors dependent on weekly jobs claims and Fed commentary to gauge inflation and consumer health. If the government reopens this week, this may flood the market with eco data flood. Watch out. Bond markets are closed on Tuesday, November 11th for Veterans Day, though U.S. stock markets will be open. This will impact liquidity in the fixed income, and it could lead to some choppiness in the markets. The economic calendar is, as we said, sparse due to the government shutdown, with only NFIB Small Business Optimism Index, we've talked about that one before, that's due tomorrow, and initial jobless claims expected on Thursday. Now, given that data void, the market will hang on every word from the long list of Fed speakers. We'll get to the Fed head parade of Musalem, Barr, Williams, Waller, Bostic, Moran, and Schmidt. There will be no shortage of news and market-moving headlines. Of that, I'm confident. Please, as always, keep your eye on the goals, stay in touch, keep planning, and finally, as we head into this week, let us take a moment to honor those who have served and those who continue to serve for the freedoms that make all of this possible. Markets may stay open, but the meaning of the day deserves our full attention. Have a great week.